Welcome to the Deep Dive, your essential briefing for navigating Luxembourg's legal, financial, and business landscape.
We're here to help you cut through the noise.
Today is Monday, May 5th, 2025, and we're diving into the latest Luxembourg Intelligence News Briefing. We've pulled together the key information that you, as professionals, really need.
Yeah, we'll cover significant wage indexation, the overall health of the Luxembourg economy, some crucial EU developments and how they impact things here.
Plus, key business and tech news, important government updates, and then we'll take a really close look at the regulatory scene.
Especially for the financial sector, right? We're talking DORA, MiCA, corporate law changes, banking sector analysis.
The works. Exactly. Our mission is simple, give you the actionable insights. So let's get started.
Okay, first up, a big one, automatic wage indexation. This was triggered in April 2025.
Right. So what is that, increase?
Yes, a 2.5% increase across the board, salaries, wages, pensions, social benefits, anything under Luxembourg law, basically.
And the when? When does this actually take effect?
Effective date is May 1st, 2025. So it's happening right now.
Okay. And the who is pretty much everyone subject to Luxembourg employment and Social Security.
That's right. Individuals, businesses.
Yeah.
It's widespread. And the why is straightforward inflation compensation. The consumer price index hit the trigger point.
And it's been a while since the last one, hasn't it?
Yeah, September 2023. So it reflects that recent pickup in the cost of living. The Statistics Office confirmed it, and they're releasing detailed numbers May 7th.
So for individuals, a bit more breathing room maybe? But for businesses?
It means higher operational costs, definitely. And you need to remember, this comes on top of that separate 2.6% hike in the minimum social wage back on January 1st this year.
Right, so a double impact on labor costs for businesses in a relatively short period. Okay, let's widen the lens. The overall economy, what did Statex Q1 report tell us?
Well, it was a bit of a mixed bag, actually. One really standout was a record inflow into Luxembourg investment funds. We're talking 60 billion net.
60 billion, wow, that's the highest in, what, 4 years?
Exactly. The why there could be caution around U.S. assets, with all the talk about trade tariffs. It sort of underlines Luxembourg's safe haven appeal, perhaps.
Interesting. But you said mixed.
Yeah, business confidence wasn't uniformly strong, and the construction sector is, well, still struggling. Employment growth seems to have stabilized, though, around 1% year on year.
And inflation. Obviously enough to trigger the indexation.
Yes, mainly driven by energy prices before April. On the government side, tax revenues were interesting. Corporate tax balances jumped up 50% year on year.
50%.
Yeah, but VAT, registration duties, fuel taxes, they were all down. So a shift in where the money's coming from. And externally, the where of concern might be the U.S., their consumer sentiment is dipping because of their own inflation and tariffs.
It really shows how linked Luxembourg's finances are to those global currents. You mentioned social benefits earlier. Were there adjustments there, too?
Yes, exactly. Following that minimum wage increase in January, the social inclusion income, REVIS, and the allowance for people with severe disabilities, RPGH, were adjusted upwards.
So continued support for vulnerable households.
That's the why, yes, along with things like the energy allowance and the ECI tax credit.
Okay. And housing. Always a hot topic here. Any movement?
We're starting to see maybe some signs of stabilization, after prices fell in 2024.
So the government measures might be having an effect? The Belligan Act, the registration duty cut?
Possibly. Those are still active, but remember, there are deadlines coming up, something for you and your clients to watch. Potential interest rate cuts down the line could help too. But confidence in construction is still really low.
Yeah.
And household debt remains high. So the how of a proper recovery, well, that's still uncertain.
Understood. What about jobs and skills? What's the picture there?
Unemployment actually dipped slightly to 5.8% in January, and job vacancies went up. So demand is there.
But I sense another but.
Well, the number of people looking for jobs also increased. So it's complex. Demand is really strong in tech, IT, cyber, data, the usual suspects, plus finance and legal compliance.
And for employers?
What seems increasingly important now is work-life balance. It's not just salary anymore. And skills shortages. That's still a persistent issue.
Okay. Any quick social or digital points before we jump to the EU level?
Just briefly, Luxembourg's still incredibly connected internet and mobile-wise. High usage. Social media is big, with Facebook and Instagram apparently leading the pack.
Right. Let's shift to Brussels then. Next generation EU funds for Luxembourg. What's the news?
Good news, mostly. The Commission gave a positive preliminary assessment for Luxembourg's second payment request. That's potentially 58 million.
Potentially, so it's not definite yet.
Not quite. The when depends on the Economic and Financial Committee's final say-so. But it relies on Luxembourg meeting 10 specific milestones and targets.
And what do those cover?
A real mix. Reforms in skills, that Skills Bridges program, affordable housing, quantum communications, plus investments in things like EV charging, digital public services, health, housing again, and energy efficiency.
So if it all goes through.
Luxembourg would have received 90 million total and completed like 57% of its plan. So decent progress.
Making headway. And broader EU policies, how are they playing out for Luxembourg?
Well, Luxembourg's always sensitive to EU shifts, right?
Yeah.
Especially competitiveness rules, regulatory simplification efforts. Those matter a lot here. And global trade, like those U.S. tariffs we mentioned, that's always a background risk. Oh, and legally, the EU noted the ruling in that sand deal dispute with the UK.
Okay, let's pivot to business and tech news. What caught your eye?
A few things happened right on May 5th, actually. Spurkeys announced a partnership with Erste Asset Management.
The Austrian firm.
That's the one. They'll be distributing Erste's ESG and impact funds here. So more sustainable investment options.
Good to see. What else?
In the tech space, they're a Luxembourg cybersecurity recruitment platform. Using AI, they acquired a French company called CyberT.
Consolidation in the cyber recruitment market?
Seems like it. They're aiming to shake up the European market, combining Cyber's AI with CyberT's like 450-strong network, clearly chasing that high demand for cyber skills.
Makes sense. Any major fund launches?
Yes. Franklin Templeton and Lexington Partners launched FLEXI. It's a Luxembourg-based private equity secondaries fund. Evergreen structure, aiming for international wealth clients, and already over $875 million in assets.
Significant. And any notable appointments?
A few key moves. Francois Schlink is the new chair at Post Luxembourg. Kiri Soma is the new country head for Simmons & Simmons here. And Jürgen Venat joined Portis Data Centers as Director of International Sales.
Okay. And you mentioned Brown-Forman.
Yeah, just a reminder, really. While they had news about Italy, it's worth remembering they set up direct distribution here in Luxembourg back in January 2022.
Got it. Switching gears to government and admin, any quick updates for our listeners?
Just a few housekeeping points. The LU Alert system had its monthly test on Monday, May 5th.
Hope everyone got the message.
Indeed. Guichet.lu keeps adding things. The 2024 income tax return is available now. Info on the extended Belligan Act is up. New pages on childcare, sick kids leave, training leave info sessions, and more procedures added to the MyGuichet mobile app. So getting more user-friendly.
That's always welcome. Anything else?
Luxembourg's hosting the Council of Europe ministerial session on May 14th. Focus on geopolitics, human rights, rule of law, and the Memorial, the official gazette, had recent publications on things like COVID jabs, traffic rules, and construction certifications.
Okay, thanks. Now let's really dig into what's probably front of mind for many listening. The regulatory and compliance tsunami, especially DORA and MICA.
Absolutely. These two are definitely dominating the financial sector's agenda right now. Implementation is key.
And the CSSF has been busy clarifying things.
Very busy. In late April, they put out a significant set of updates, really trying to fine-tune how the rules apply, especially distinguishing between entities directly under DORA scope and those that aren't.
So breaking that down, ICT risk management first.
Right, so Circular 2750, which covered ICT risk, it's been amended. Now, it mainly applies to entities not directly covered by DORA. Think specialized PFS, post-Luxembourg, non-EU branches.
Okay, so what about DORA entities?
Well, PSPS payment service providers have specific requirements moved to a new circular, 24880, which adopts the EBA guidelines.
And outsourcing, similar split.
Pretty much.
Yeah.
Amended Circular 22806 on outsourcing. Well, for DORA entities, it now only applies to business process outsourcing, BPO. For non-DORA entities, it still covers both ICT and BPO.
Right. And there's another new one for DORA entities ICT outsourcing?
Yes, Circular 25882. This is crucial. It covers how DORA firms handle third-party ICT services, reporting obligations like notifying critical contracts, maintaining that register of information, the ROI cloud definitions, needing a cloud officer. Lots in there.
Okay, so careful reading of those circulars is essential to know which regime applies. What about MICA?
Another big batch from the CSSF on April 30th.
Yeah.
Circulars 25885 right through to 25890. These basically adopt various ESBMA and EBA guidelines needed for MICA to function.
Covering what specifically?
Things like compliance for issuers of stablecoins, RTs and EMTs, how to classify crypto assets versus traditional financial instruments, rules for soliciting clients, policies for crypto transfers, security standards for crypto offers, and templates for tests under MICA. It's the detailed plumbing, really.
Plus other general CSSF updates around the same time.
Yeah, updates to FAQs on reporting, a temporary trading suspension for one company's securities, guidance on fixing errors in that DORA Register of Information, details on the aptitude test or EAP, that extension for the DORA OAI deadline we'll come back to, and a snapshot of the investment fund sector's situation.
It's a deluge of information. Let's focus on DORA's practical impact. What are the fundamental shifts for financial firms?
Okay, DORA is about building resilience. It forces a proactive stance. Firms need a really solid ICT risk management framework from identifying risks right through to recovery.
And incident reporting changes, too.
Significantly. It's now through the CSSF's eDesk portal. There are specific timelines, and it replaces the old circular on IT incidents, 24847. That's a key operational change for you to note.
What about testing?
Resilience testing becomes much more formalized. Annual testing is required, and for some firms, that might mean advanced stuff like threat-led penetration testing, TLPT, or using the Tyber-Low-U framework here.
Yeah.
And you have to report on it.
And third-party risk. You mentioned the Register of Information.
Huge focus. Due diligence on your ICT suppliers, managing concentration risk, ongoing monitoring, specific contractual clauses.
Yeah.
It's much stricter. And that register information, the ROI, is mandatory for tracking dependencies on ICT third parties. Plus, critical providers will face EU-level oversight.
And ultimately, the buck stops where?
With the board and senior management, DORA places ultimate responsibility squarely on them. They need to be actively involved in strategy, policy, oversight, budgets. And they need to have the necessary knowledge. Internal audit also has a key role.
So the message is, act now, don't wait for every single detail.
Absolutely. This requires a structured plan, integration across the business, IT, risk, compliance, legal, ops. They all need to work together. Waiting isn't really an option, even if some EU Level 2 measures are still being finalized.
Okay. Now, MICA. Big implications for the crypto world. What are the essentials for our listeners?
MICA is groundbreaking because it's the first harmonized EU framework for crypto assets and crypto asset service providers, CASPs. The goal is legal certainty, investor protection, but also fostering innovation.
And what does it cover? And maybe importantly, what doesn't it cover?
It covers most crypto assets like Bitcoin, Ether, stablecoins, utility tokens. Crucially, it generally doesn't cover crypto assets that already qualify as traditional financial instruments under MiFID II. ESMA guidelines help clarify that boundary. And generally, NFTs are outside the scope too, unless they have features that make them look like financial instruments.
So if you want to offer crypto services,
You'll need authorization as a CSSP from the CSSF here in Luxembourg. That involves meeting requirements on capital, governance, operational controls, conflicts of interest, safeguarding client assets, complaint handling, the whole 9 yards. But the upside is an EU passport to offer services cross-border.
is it easier for existing regulated firms?
There's a simplified notification procedure, yes. But non-EU firms wanting to target EU clients, they'll generally need to establish an entity within the EU.
What about issuing new crypto assets?
Generally, issuers need to publish a detailed white paper. Think of it like a prospectus outlining the project, the tech, the risks, the rights attached. And marketing needs to be consistent with that white paper. There are some exemptions, though.
And stablecoins get special attention.
They do. Asset reference tokens, ARTs, and e-money tokens, EMTs, have specific, often stricter authorization regimes and ongoing obligations regarding reserves, governance, and redemption rights. Significant ones might even face direct supervision by the European Banking Authority, or ESMA. There are also potential restrictions if a stablecoin becomes too widely used to manage systemic risk.
How does AML-CFT fit in anti-money laundering?
It's integrated. Luxembourg law already brought CASPs under the AML-obliged entity umbrella back in February 2025. So they need a full AML-CFT framework, customer due diligence, suspicious activity reporting, all that. MICA reinforces this and aligns with the transfer of funds regulations travel rule, meaning information about sender and receiver needs to accompany crypto transfers. Enhanced due diligence might apply for things like self-hosted wallets or larger transactions.
And Luxembourg's implementation timeline?
The CSSF is the competent authority. There's an 18-month transitional period running until July 1st, 2026 for VASPs that were already registered here before December 30th, 2024. But the CSSF is encouraging firms planning to apply to start talking to them early.
What's the expected market impact?
The hope is enhanced investor confidence, attracting more institutional players. It could really cement Luxembourg's position as a digital asset hub. But there are challenges too: compliance costs, transition complexities, We've already seen some exchanges delist certain stablecoins in anticipation.
Okay, let's hammer home those upcoming deadlines again. Crucial dates for May and June 2025.
Right, top of the list, that DORA Register of Information, the extended deadline is May 31st, 2025.
May 31st. Got it.
Then the AED AML CFT reporting for unregulated AIFs. For our AIFs, the deadline was also May 31st, 2025. For other unregulated AIFs, it's June 30th, 2025.
Okay, end of May for RAIFs, end of June for others.
Then, the RCS, the Business Register. That free period to update your LNIN, your national ID number, ends May 31st, 2025. After that, fees apply, and from October 1st, you might face filing blocks if it's not done.
So don't delay on the LNIN update?
Definitely not. Also, ESMA's guidelines on ESG fund names, the transition period ends May 21st, 2025.
ESG names, May 21st.
And the EBA consultation on the technical standards for the new AML package closes June 6th, 2025.
June 6th for feedback on AML RTS.
And while the AIFMD2 UCITES rules on liquidity management tools aren't fully transposed yet, the related ESMA technical standards were expected back in April, so that's something to keep watching.
That's a packed compliance schedule. The big picture here feels like, well, intense pressure.
It really is. The sheer volume, the overlap between DORA, MICA, AML, ESG is putting a huge strain on resources. That Row I extension for DORA, probably assigned firms are finding it tough.
So the key takeaway for you listening?
Integrated compliance. You can't afford silos anymore. IT, compliance, legal, risk, operations, they absolutely have to work hand in glove. Meticulous planning, cross-functional teams. That's the only way to navigate this complexity, even with talk of EU simplification efforts down the road.
Okay, let's shift focus specifically to the investment fund sector, a cornerstone of the Luxembourg economy. What's on the regulatory horizon there?
Well, beyond the cross-cutting things like DORA and ESG, the big specific development is AIFMD2, the revised Alternative Investment Fund Managers Directive.
Right, that came into force recently.
Yes, April 15th, 2024. Member states, including Luxembourg, have until April 16th, 2026 to transpose it into national law. And new reporting under it starts April 16th, 2027.
And what are the main areas it changes?
Several key aspects: delegation arrangements, liquidity risk management tools, supervisory reporting gets more detailed, updates to depository and custody rules, and importantly, a new harmonized framework for funds that originate loans.
Let's touch on delegation, always sensitive in Luxembourg.
The definition is broadened a bit, but it strongly reaffirms the AIFM's ultimate responsibility. Crucially, it clarifies that distributors acting on their own behalf, selling funds alongside other products, are not considered delegates. That's important for the distribution model here. But reporting on delegation gets more extensive.
And liquidity management tools, LMTs.
AIFMDT aims to harmonize these across both AIFs and UCITES. Managers will need to choose at least 2 LMTs from a specific list for each open-ended fund they manage, unless they can justify exemptions. Detailed policies are required. ESMA is working on technical standards for this, expected by April 2025.
And loan origination, that's new territory for EU regulation, isn't it?
It is, yes. The first EU-wide rule specifically for AIFs that originate loans. They'll need proper credit policies, risk assessment processes. There are rules against purely originate-to-distribute models, limits on concentration and leverage, conflict of interest rules.
Are all loan funds treated the same?
No, there are stricter rules for funds predominantly engaged in loan origination labeled loan originating AIFs, and there are specific requirements for open-ended loan funds, which ESMA will detail further. There's a grandfathering period for existing loans until 2029.
And ESG, still a massive driver.
Absolutely undiminished. Complying with SFDR, the taxonomy, avoiding greenwashing, it's central. The CSSF is actively supervising this, using tools like the long-form report. We saw that first SFDR sanction last October, a clear signal. The ESG fund names deadline is May 21st. CSRD is phasing in. And the whole SFDR framework itself might be reviewed, potentially moving towards clearer product labels. It's constantly evolving.
What about selling funds across borders, CBDF?
The cross-border distribution framework, in place since 2021. AIFMD2 adds some clarifications around delegation and marketing. But challenges remain with varying national requirements. Luxembourg's dominant position faces competition, but things like LTIF 2.0, the revamped long-term investment fund, are seen as real opportunities.
How are the market dynamics looking? Fund assets, flows?
Assets under management remain huge, around $5.75 trillion for all UCIs at the end of March 2025. We saw those record net inflows of $60 billion in Q1, remember. Though flows month to month can fluctuate. Geopolitics, trade tensions, they definitely impact investor sentiment. ESG UCIs alone account for something like $2.25 trillion in assets.
And alternatives, private equity.
Still a very strong growth story for Luxembourg. That new Franklin Templeton Lexington fund is just one example. Luxembourg is really the go-to domicile. Private equity and related funds hit $865 billion in NAV, up 25% year-on-year. Unregulated structures like RAIFs and Lux LPs are booming, and there's increasing focus on technology and PE, like the LPA's recent PE Tech Day.
So lots of new funds launching using various structures. What about the companies servicing these funds?
The service provider landscape, admin, custody, transfer agency, audit remains quite concentrated among the big global players. You know the names: State Street, SS&C, which owns IFDS, JP Morgan, the big four audit firms. There have been some deals, like State Street buying Mizuho's custody business and the upcoming IFDS takeover completion, which will further consolidate things.
What are the industry bodies like LFI, LPEA, ILA, ABBL focusing on?
They're all heavily engaged. ALFI is doing roadshows, LPEA promoting PE internationally and focusing on tech, ILA working on director education and governance, ABBL tackling regulatory simplification, cybersecurity, sustainable finance. They're all grappling with these regulations and market shifts. Plenty of events coming up in May and June, too, covering all these topics.
So the context for the fund sector is transition.
Yeah, transition and complexity. A move towards more retail access to alternatives, driven by LTIF 2.0 and the retail investment strategy. Continued growth in private markets, but also the challenge of balancing flexibility for sophisticated managers with tighter retail rules. AIFMD2 adds complexity, maybe favoring larger players. And overlaying all that is technology AI, DLT driving efficiency, but also bringing challenges, especially DARA compliance. It might create a divide between the tech-savvy and the laggards.
Let's switch tracks to corporate law and governance. What are the key legislative changes you've seen?
A big one is the finalization of the Mobility Directive transposition. That was the law for March 2025, effective April 1st.
And what does that do practically?
It amends the labor code, boosting employee rights information, consultation, participations, specifically when companies undergo cross-border mergers, divisions, or even conversions. It applies to SAs, SCAs, SARLs, so more employee involvement needed in those cross-border restructurings.
Okay. Anything else significant?
The tax treatment for partial liquidations and share buybacks got clearer. The conditions for getting a withholding tax exemption are now codified in law. Things like share classes, distinct rights, repurchasing the whole class, fair market value pricing. Provides more certainty there.
And the RCS filing changes, the LNIN mandate.
Yes, we mentioned the deadline. Since February 1st, every natural person registered with the RCS needs that Luxembourg National Identification Number, the LNIN. Free updates until May 31st, then fees and potential filing blocks from October 1st if you haven't provided it, plus some other required ID details, so action needed there.
What about that accounting law modernization bill?
Draft Bill 8286.
Great.
Introduced last July, but honestly, its current status seems a bit uncertain. Haven't seen much movement recently.
And non-performing loans?
Right, the MPL-directed transposition. That resulted in the law of 15 July 2024, which created that new credit servicer category of PFS professionals of the financial sector.
How are governance standards evolving alongside the law?
Governance expectations are definitely rising. ILA, the Directors Institute, is very active connecting startups with directors, offering certifications like the CGO, Chief Governance Officer, running forums. But interestingly, recent data showed board gender diversity kind of stagnated.
But board oversight duties are increasing across the board.
Massively. We talked about DORA, ultimate board responsibility for ICT risk, needing active involvement and knowledge. ESG is similar, integrating sustainability, overseeing risks, ensuring disclosures, preventing greenwashing, and AML-CFT. The board's responsible for appointing the key officers, RRRC, ensuring the framework is solid, providing resources. Active management involvement is crucial.
So general governance best practices are under scrutiny.
Yes. Board composition independence, expertise, diversity, how boards organize themselves, meetings, approvals, clearly defined roles, managing conflicts of interest, director pay. For listed companies, the 10 principles and related disclosures remain key.
And the company secretary role, is that changing too?
It really is. It's moving away from just admin towards being a strategic advisor. Ensuring compliance, yes, but also advising the board and management, understanding the business strategy, facilitating good discussions, staying ahead of regulatory changes. It demands a higher skill set. Outsourcing is common, but the demands are high. ILA even offers a certification now.
Let's touch on corporate tax updates. What are the main changes for 2025?
Okay, quick rundown. The corporate income tax, CIT, Rate was slightly reduced at 16% for profits over 200K, 14% below 175K. Aggregate rate in Luxembourg City is now around 23.87%.
Minimum net wealth tax simplified.
Yes, M&WT calculation is now simpler, based purely on the total balance sheet size, with a progressive scale from 535 euro up to 4,815.
Any changes to the participation exemption?
An interesting one, companies can now choose to waive the participation exemption for dividends or gains, but only if the exemption is based solely on the acquisition cost threshold, not the 10% holding threshold. It's an annual choice per participation.
Interest deduction limitation rule.
Minor tweak there, clarifying the single entity group equity escape clause.
Subscription tax.
The exemption for ETFs was extended to cover actively managed UCITS ETFs. Good news for that segment. But the minimum tax for SPFs, the family wealth management companies, went up to €1,000.
And VAT on director fees. Still complex.
The guidance suggests fees might be outside the scope of VAT if the director isn't acting independently and performing an economic activity. But it's very fact-specific based on CJU rulings, not always straightforward.
E-filing becoming mandatory.
Yes, for withholding tax returns on director's fees and also wage salaries starting from 2025 returns.
Okay. So, the overall context for corporate law and governance is more complexity, more responsibility.
Definitely. The governance burden, especially in the financial sector, has really ramped up. DORA puts ICT risks squarely on the board. ESG and AML oversight are non-negotiable. The Mobility Directive adds new employee participation rules to navigate in restructurings. It demands more diligence, more expertise, and more time from boards. Potential personal liability is also a factor, and the COSEC role becomes even more critical in helping steer the ship through all this.
Right. Let's turn to our final deep dive area, the banking sector. How are banks coping with all the new payment and tech regulations?
It's a major focus. The Instant Payments Regulation, IPR, is probably the biggest immediate challenge operationally.
You remind us of the key requirements.
Okay, PSPs, including banks, had to be able to receive instant payments from January 9th this year. And by October 9th, 2025, for Euro area PSPs, they must be able to send them too. We're talking 10-second processing, 247 and 365.
And the cost?
Can't be higher than standard credit transfers. Plus, a mandatory free verification of payee VOP serviced by October 9th, 2025 to help combat fraud. And sanction screening processes need adapting more frequent checks.
Luxembourg has passed its own law, too.
Yes, Bill 8460, effective April 11th. It integrates the EU regulation, sets penalties, and importantly, gives payment institutions and e-money institutions direct access to payment systems and central bank accounts for safeguarding funds.
What's the impact on the banks themselves?
Significant operational and tech upgrades needed. Security is paramount, implementing VOP, enhancing fraud detection. Screening processes need updating. There could be pressure on fee revenue from traditional transfers, and it introduces new operational risks. It's a bigger hurdle for some, maybe private or corporate banks, than for retail banks who are often earlier adopters. Collaboration seems key. We see examples like SED, BIL, and LuxHub working together. ABBL has a task force on it too.
And for customers, individuals, and businesses,
the benefits are clear. Faster access to funds, convenience, potentially lower costs. That VOP service should enhance security. For businesses, it helps cash flow, speeds up refunds, could boost e-commerce, P2P payments. But the flip side is the irrevocability once sent. It's generally gone.
And all this tech change happens under the shadow of DORA.
Exactly. Banks have to comply with DORA's resilience requirements while implementing IPR's tech demands. It's pushing adoption of AI and automation for efficiency, compliance, RegTech, risk management, customer service. But AI itself needs strong governance, which the CSSF is watching via its innovation hub.
And MICA's impact on banks.
We mentioned the simplified notification route for existing regulated firms like banks wanting to offer crypto services. But they still need to integrate these services carefully with all existing rules, AML, DORA, consumer protection.
Okay, let's look at financial performance and market position. How's the sector doing?
Banks showed resilience in 2023 and into 2024. Mid-2024 saw record profits, largely thanks to rising interest margins. BGL, BNP Paribas reported solid income growth for 2024. Spurkeys had strong profits too.
But is that sustainable?
Profitability is expected to moderate. Funding costs are rising. Margins are likely to compress. Net interest income growth already slowed late last year.
What about asset quality and risk?
Overall, non-performing loans, NPLs, are still low by international standards, but there has been some deterioration, particularly noticeable for domestic banks and linked to real estate and SME exposures. BIL saw its non-performing asset ratio rise, leading to a negative outlook from S&P recently. High household debt is also a known risk factor.
Are the banks robust enough?
Recent stress tests by the CSSF and ECB suggest they have the capacity to handle shocks. But the ECB's supervisory priorities clearly include resilience to macro-financial and geopolitical risks.
Lending and deposit.
Credit growth was pretty subdued, even negative, through 2023 and early 2024. Mortgage lending started to recover a bit late last year, but resident deposit growth was actually quite strong early in 2025. Interbank lending also picked up.
Any specific bank news we should mention?
We touched on Sparky's ESG partnership, BGL, BNP Paribas' solid 2024 results, BIL's slight asset quality deterioration noted by S&P. Clearstream continues to be a major infrastructure player. State Street's acquisition activity, these major players shape the landscape.
So looking ahead for 2025-2026, what are the big strategic challenges?
It's a confluence of factors. Navigating that intense regulatory complexity, DORA, MiCA, AML, ESG, IPR is huge. Continued digital transformation and the associated cybersecurity risks. Economic and geopolitical uncertainty casting a shadow, keeping a close eye on asset quality and credit risk given the NPL uptick in household debt. Competition remains fierce international players, domestic banks adapting like ING's exit, BIL shifts, and fintechs nibbling away, especially in payments. And finding and keeping the right talent and skills is always a challenge.
So the context for banking is significant pressure and transformation.
Absolutely. Heavy regulatory burden demanding investment. Digital transformation is essential, not optional, especially with instant payments, AI, all needing to fit within DORA's framework. External uncertainties require caution. The recent NPL signs need vigilance. We might see further market consolidation or specialization. Fintech competition is real. And the strategic moves of the big banks here will be critical to watch.
Briefly then, let's look at the broader ecosystem, the financial and legal service providers supporting these sectors. Key trends.
Technology is transforming everything. AI and automation are being adopted more widely, with startups emerging here. Cloud adoption is accelerating. Hybrid, multi-cloud, even sovereign cloud concepts like Clarence are being discussed, all under DORA's outsourcing rules now.
Blockchain and digital assets.
Luxembourg's definitely positioning itself as a hub. Tokenization, DeFi experiments. MiCA provides the framework. We see established players like Clearstream offering crypto custody, specialized providers emerging, fund platforms exploring DLT.
And cybersecurity.
A massive growing focus, obviously amplified by DORA. Threats are increasing. We saw that recruitment consolidation with cybersecurity. The House of Cybersecurity plays a key role. It's a critical area.
What about the traditional legal and advisory firms?
They're incredibly busy helping clients navigate all this. The major Luxembourg law firms are advising heavily on regulation, transactions, fund structuring. The Big Four advisory firms are deeply involved in audit, tax, and especially advisory services around DORA, ESG, digital transformation. Their combined turnover is huge.
And recruitment reflects these trends.
Yes, strong demand continues in finance, tech, legal, compliance. Flexibility is key for attracting talent. But skill shortages, especially in highly specialized areas like cybersecurity and specific regulatory compliance, persist.
So the context for the broader industry is intense change.
Profound transformation, I'd say, driven by regulation and tech. DORA and MiCA are creating huge demand for specialized services. Law and advisory firms are core to implementation. AI, cloud, blockchain demand new solutions and expertise. Opportunities abound in fintech, regtech, cybersecurity. But finding the skilled people to deliver is the bottleneck.
Okay, let's pull back one last time for the cross-cutting economic and policy context. What's the overall outlook?
After a contraction in 2023 and slower growth in 2024, the projections are for a rebound in 2025 and 2026. Assuming monetary policy eases, external demand picks up. But there are downside risks, trade issues, geopolitics, weaker than expected external demand, the domestic real estate situation. Global growth is also moderating.
Inflation.
It eased off in 2024, but forecasts from Statech and the IMF suggest it might rise again this year as energy price caps phase out before falling back, hence the indexation trigger we discussed.
And Luxembourg's competitiveness, strengths and weaknesses.
Strengths are still there. Solid fundamentals, stability, that AAA rating, the strong financial center. Challenges include declining productivity growth, rising labor costs partly due to indexation, skills shortages, reliance on the financial sector, relatively low business investment outside finance, high housing costs, and that growing regulatory complexity.
So government policy aims to address these.
Yes, efforts focus on tax environment, attracting talent, fostering innovation. EU initiatives like the Capital Markets Union or single market improvements could also be opportunities.
What about public finances, budget, debt?
After a surplus in 2023, deficits are projected for 2024 through 2026. That's due to support measures, tax cuts, spending increases. The IMF sees the 2025 budget as expansionary.
And debt, still low.
Relatively low, yes, but rising. Projected to hit about 27.5% of GDP in 2025. Longer-term pressures from aging, climate transition, defense spending are concerns. The IMF supports Luxembourg having a national fiscal rule and wants better data and risk analysis. The OECD also noted some deterioration in regulatory policy processes.
In tax policy affecting professionals and households,
Right.
any key changes?
Yes, the personal income tax scale was adjusted for inflation 2.5 indexed bands. Benefits for tax class 1A improved. Low earners on minimum wage are effectively exempt. Tax credits for single parents and KIOs were increased.
What about attracting talent?
The impatriate regime was simplified, a 50% exemption up to a 400K cap. Limits for profit-sharing bonuses were increased. There's a new tax-exempt bonus for young employees and a new overtime tax credit aimed partly at cross-border workers.
Any other tax points?
We mentioned the VAT on director fees clarification. Pre-filled tax returns are being rolled out, though caution is advised to check them carefully. The Belligan Act extension for housing. A longer speculation period for real estate capital gains, now 5 years. And some changes to company car benefit in kind calculations.
So the overall economic and policy implication is trying to balance short-term support with long-term competitiveness.
Exactly. Strategy involves supporting households, attracting talent, keeping corporate taxes competitive, incentivizing specific sectors like ETFs, while facing challenges like financial sector reliance, productivity, labor costs. Long-term fiscal sustainability needs careful management. Success really hinges on navigating those global factors effectively and ensuring domestic policies hit the mark.
Well, that brings us to the end of this packed deep dive into the Luxembourg Intelligence News Briefing for May 5th, 2025.
You've covered a lot of ground wage indexation, economic trends, EU impacts, business and tech moves, regulatory earthquakes like Dora and Mika.
Plus investment funds, corporate law, banking analysis, and that broader policy context. As you've heard, it's all deeply interconnected, especially for you working in Luxembourg's legal, financial, and business sectors.
Staying ahead requires understanding these links.
Absolutely. To make sure you don't miss our future analyses and stay informed, please do hit that subscribe button wherever you get your podcasts.
It's the best way to keep up in this fast-moving environment.
This has been the Luxembourg Intelligence News Briefing.